I'm Owen Bigland. This is the Inside Edge video blog. Okay, this blog is going to be on investing in Vancouver real estate. Buying a Vancouver special with multiple suites and a laneway house, or buying a studio or one-bedroom condo in downtown Vancouver or Mount Pleasant or Richmond or New Westminster. Putting a tenant in it and keeping it, which is how I've always worked. And if you stick to that program, you'll do very well with it. So I get a lot of people that will often, in the YouTube comments here, will often say, when you're a realtor, so of course you're bullish long-term on real estate, and you don't like the stress test, and you don't like Mr. Siddell calling for a correction, and you don't like the restrictions on building and all the other things that kind of keep people out of home ownership, how difficult it is to qualify for a mortgage. And they couldn't be more wrong. I think a lot of people don't realize that I'm also a landlord, and I often get a lot of my clients that jokingly will say to me, "Owen, don't give away all our secrets. It's a zero-sum game. We need these renters." And in a lot of ways, they're right. Here I am, because I think there's room for everyone to own a home, and renting and a quality pool of tenants is never going to go out of favor in a city like Vancouver. It's an endless new stream of people that are renting, because again, nothing wrong with renting short term. You pretty much have to while you're saving for the down payment and getting your career underway. That's how most people start. But eventually, if you can, you should be saving for the down payment and then moving into home ownership. But a lot of my clients will say, "Stop giving away all our secrets. We need these tenants." And in a way, they're right. I'm a landlord. I've got, people know, a lot of investment units both in Vancouver, and I still own a lot of my early ones that I bought back 30 years ago in Richmond. So I work both sides of it. And when you get comments and predictors that come out calling for a 10 or 18% crash, which they've been saying for 35 years here in Vancouver, run-of-the-mill corrections are very normal. As a matter of fact, a 10% correction I would not call a crash. A crash is 50% or more. But those should be expected every 2 to 3 years. I've been through so many of them, I've lost count. But, those type of things, the tightening on the mortgage regulations, the stress test, these things all are kind of music to myself and my investors' ears. Because all this does is freeze people on the sidelines, or keeps them from home ownership, and keeps them in this incredibly lucrative rental market for landlords. And it does. That's why the rents continue to go up. That's why I was getting on units in downtown Vancouver that I was getting $1,400 or $1,500 a month for just 5-6 years ago. I'm now getting $2,300 a month for. So restrictions on people buying and freezing people on the sidelines calling for corrections is actually benefiting people like me and my other investors. But again, I'm trying to give people the tools they need to rise above that, trying to show you the advantages to home ownership long-term. And renting long-term is a recipe for disaster. All you have to do is do the math on it. What it's going to cost to just rent a simple one-bedroom for the next 30, 40, 50 years in Vancouver. It's going to be well over $1 million after tax, with zero to show for it. So, restrictions like this, I think a lot of people don't realize that, I'm a fairly major landlord here, and all it's doing is keeping my rental pool and the quality of my tenants continuously strong. We just don't build enough units here. We never have. It's a trickle-in supply. The NIMBYs, all the other restrictions that the province and the city of Vancouver puts on developers. Not easy to get a mortgage. Anyone that says it is in Canada has never applied for a mortgage. They don't have 2 dimes to rub together. They're renting and they're angry. Incredibly difficult to get a mortgage in Vancouver. You are probably anything over $1 million conventional mortgage. If you're buying an investment unit, conventional mortgage. Everything is 20% down or more here. So it's not easy. But my game plan that I've been laying out here and I talk about in my book, principal residence should be your first step. Absolute first step. Not going to be easy. Live at home, milk it for all you can while you save for the down payment. Once you've got the down payment and you get qualified, it's smooth sailing after that. Principal residence number one. After that, max out your TFSA and your RRSP. Third, and I would do that through low-cost ETFs, just index invest. If you really have an interest in this kind of thing, then down the road and you've saved your first $250,000 for retirement, then you can start buying some good dividend-paying blue chip equities, like an Apple or a Johnson & Johnson or a Pfizer or a Visa or Home Depot. Third and final step to diversify is to buy an investment unit. That's your third and final step. You're going to have to put at least 20% down, leave yourself a buffer for interest rate hikes. You're taking advantage of the leverage. Leverage, again, is the only way you're going to create any type of wealth. There's not enough working hours in the day, and you're not going to save your way to retirement. You're going to have to get it invested in equities, for instance, that can go up and down, but you have to settle. If you want those superior returns, you're going to have some volatility there. Get used to it. It's the only way it's going to go. Buying an investment unit, you're borrowing 80% at 2%. The interest is all deductible. The property taxes are deductible. The maintenance fees are all deductible. The repairs are all deductible. Your tenant is going to do all the damage to that principal payment via his $2,200 or $2,300 a month rent check. Or if you're buying something in Richmond, maybe it's an older wood frame for $350K and you're getting $1,400 or $1,500 a month for it. Buy it, keep good tenants, keep the property in good condition, and just hang on to it. Let time, compounding, capital gains, paying down the debt, taking advantage of the interest, do its thing. And when you sell that, hey, it's nice. It's not taxed at your full marginal rate. You're going to get capital gains tax advantage on that, 50%. When it's your principal residence, of course, it's the best thing we have. It's the only shelter we get in Canada. All the gains are tax-free. That's why most Canadians, when they retire, the largest asset they own is their house. It's not their RRSP or their TFSA. But those are the three steps. And what makes being an investor here as the third step so attractive? Again, leverage, incredible pool of high quality tenants here. And the reason you've got such high quality tenants here and ease to rent is, I revert back to predictors that are always calling for the crash, 10 or 18%, always, which freezes people on the sidelines. Difficulty to get a mortgage, the stress test, the lack of supply. We never have enough supply, and I've got news for you. We will never build enough supply here to reach the demand, especially in Vancouver. And that's why if someone has the budget, I usually tell them and they want to buy an investment unit, if you've got $650,000, $700K, if you can get up into that budget, buy a piece of downtown Vancouver. Because you can still get you something around $1,000 to $1,100 a square foot. Everything from this point on that's coming online as far as new construction is going to be starting at $1,500 a square foot and up over $3,000 a square foot. I'm actually going to be purchasing another unit. I buy systematically. I kind of funnel some of my money into the stock market, and then I save up money in a side fund to buy another property. I will be pulling the trigger in the next 6 to 12 months on another downtown Vancouver condo. So I'm still a buyer. I'm going to take advantage of the low interest rates, and it's just a buy, hold, and what I call the go ship to wealth. Final thing I'll talk about here too, just a couple other little digs here too. You know, as you guys know, I've kind of put it to bed here with Mr. Siddall and CMHC. He never did want to answer any of my questions about the alternative to being a homeowner, how that rental, long-term rental is going to work out, why he's telling people to time markets and wait for his bold prediction to come through. Why not just buy and hold the property and enjoy it? Never answered any of it. The reason I use him is because he is exactly like dozens and dozens of people that I've had over the years on my blog here, as you guys know. They're always complaining. They never have an alternative. That's the crazy thing with these people. They just say the market's overpriced and it's going to crash. But they never have a game plan. The reason they don't have a game plan is because they are just hopelessly lost, most of them. They don't have the 100 or 150K down payment and never will. They've never talked to a bank to get pre-approved. I don't know why they just perpetuate their problems by complaining. They should just channel that energy into themselves and getting better, and they'd be far better off. But you know, it never ceases to amaze me that people like Mr. Siddall, even though CMHC's mandate is to help people get into home ownership, especially young people, That's their mandate, not to make predictions that the market's going to crash. And if it doesn't happen right away, then in Wall Street they call talking down the book, like short sellers. So hopefully that will come to fruition. It's very strange. But they try and keep young people, I've done so many blogs on this, they try and keep young people out of home ownership on an appreciating asset at 2% interest rates in a vehicle that will shelter all your capital gains, free and clear of taxes. They want to keep you out of that, which would be called good debt, buying a home, using some leverage, borrowing at 2% in a tax-free vehicle. They want to keep you out of that, but they do not talk at all or want to do any regulations on credit card debt, which is running at 20 and 25%, loan sharking. That just goes unchecked, and that's why I tell people why you want to own all the Canadian banks. I've owned the Canadian banks for almost 25 years now. I continually add to them every single year. I own them all. Large portfolio. It's all in my unregistered accounts because I collect those fat dividend checks. I get a bit of a tax break on it with the Canadian dividend tax credit. The yields on these banks are, north of 5%. I mean, back in March, I was picking up Bank of Commerce and TD and Scotiabank at 6.5%, 7% yields. Crazy. Just buy and hold the Canadian banks. It's a license to print money. They're the ones that are collecting these 20 and 25% interest rates off the credit cards. Just buy and hold them. Final thing I'll close with, because a bunch of people were making comments about this. I'll close it out here. Listen, I have no ill will towards Mr. Siddall. I just think it's strange the predictions he's making. He's putting himself out there for sure. And I've done blogs on predictors, and if they're right, hey, great. Because eventually he is going to be right. We are going to get a 10 or 15% correction in Vancouver real estate eventually. We just don't know when. But that's par for the course. Buy your home, enjoy it. Forget about trying to time the market. Take advantage of the low interest rates. Take advantage of the principal residence exemption. You have a 30 or 40 need year anyways. Trying to time a market, I can tell you, you will be permanently frozen on the sidelines. But we had people were kind of commenting the same old analogy, and I've had this on my blog too, asking, even though, I'm a realtor, I'm a listing realtor, that's my primary business, but I probably work with 20 buyers a year. I probably sell in downtown Vancouver at least 10 or 15 investment units. As you guys know, I work a lot with investors. But I'm also a landlord. So restrictions on keeping people out of the housing market is, benefiting me even more. I'm just trying to give you guys the tools here to rise above that, because there's always going to be plenty of renters for me. My friends joke about it. Don't give them all our secrets, but there'll always be a continuous supply of new renters coming in that are moving to Vancouver and are going to need to rent for a few years. So I'm not worried about that as an investor. But he had that analogy, which I've heard many times before, asking a realtor whether you need to buy a house or buying and selling a house, is asking a barber whether you need a haircut. Well, let me show you how ridiculous that analogy's been around for decades, and it's dumb. Who are you supposed to ask for your haircut? I don't use a barber, I use a stylist, first off. That's why I keep my hair so good. I put my trust in my stylist. He's the one that I give carte blanche to. You let me know. It cuts a little shorter in the summer, leaves a little longer in the winter. Just do whatever you want, because this guy's the best. He's got a salon in Yaletown, and he's the expert on it. I have my trust in my stylist, so I'm going to leave it up to him. Who should I ask if I need a haircut? My auto mechanic? Should I ask him if I need a haircut? Or should I ask my hairstylist when I need an oil change? That's how ridiculous that is. If you don't trust your advisors, is what I'm trying to say here. If you don't trust your advisors, then you've got the wrong advisor. And I've done many blogs on this about financial planners. You're best to do it on your own. Just index invest. Don't pay these ridiculous fees for money managers, because 90% of them can't beat the index. Why are you paying them 1 or 1.5%? It's a blatant, I don't know if I call it a ripoff, but it's just not worth the money. Just index invest on your own. You'll do far better. But if you don't want to trust your advisor, whether that's your real estate advisor or your financial advisor, then you need to get another advisor. I put my trust in my hairstylist. You know, the alternative, as I say, is asking my auto mechanic whether I need a haircut or asking my hairstylist whether I need an oil change. You got to get another one if you don't put your trust in that person. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.